Howdy, everybody. Welcome to Liberty Call. Today is February 7th, 2024. Hope everybody's having a good day out there. It's kind of an overcast day here in Colorado. The sun is trying to peek out through the haze outside, but still snow all over my front yard. So if you want to come by, I'll make you dinner and you can shovel. Anyways, all right. Well, like I said, hope everybody's having a good day out there. If it is your first time watching Liberty Call, if you could do me a favor, if you could give me some thumbs up, like, share, subscribe, follows, and press the notification bell. All righty. Well, let's go ahead and get into today's numbers. It looks like markets were in a pretty good mood, at least here domestically, not so much around the globe. The Dow Jones was up 0.4%, 156 points, closed at 38,677. S&P 500 was up 0.83%, closed at 49,95. NASDAQ up 0.95%, closed at 15,756. The VIX was down 1.76% today. It's at 1283. It was up about 0.4% earlier, which, again, the VIX and the markets are not quite working that in tandem like they normally do, or inversely. All right. Canada was up 0.05%. Mexico or Brazil was down 0.36%, and Mexico was up 0.09%. Over in Europe, a little more red. Germany was down 0.65%. The UK down 0.68%. France down 0.36%. The Netherlands down 0.12%. Spain down 1.15%. Italy down 0.45%. Switzerland down 0.31%. And Portugal down 0.8%. I'm sorry. Portugal, down 0.87%. Russian exchanges both in the green today. The MOEX up 0.54%. The RTSI up 0.51%. And the Asian markets, the Nikkei in Japan was down 0.08%. Australia up 0.45%. New Zealand up 0.23%. In China, the Shanghai was up 1.44%. The Shenzhen Component up 2.93%. China 50 up 0.8%. DJ Shanghai up 1.99%. Hang Seng down 0.34%. And the Taiwan weighted appears to have still been closed. So if you remember last week, the Asian markets were in the crapper. And this week, this is the second day of some pretty big bounce backs. So we'll see. I know there's some contagion with a lot of the real estate in the Chinese markets that's, I guess, coming due on their loans, and there's not any tenants, so there's no cash flow. So it's a big mess. It's a big mess out there, folks. All right, let's go ahead and get to today's market recap. S&P 500 set sights on 5,000 mark as Ford, Chipotle push consumer stocks higher. On Wednesday, the S&P 500 advanced, edging closer to the historic 5,000 milestone, propelled by a surge in consumer stocks, buoyed by strong earnings reports from Chipotle and Ford. Ford Motor Company shares surged nearly 4% after the automaker surpassed analyst expectations with its annual guidance and fourth quarter results. Ford's upbeat guidance projected $10 to $12 billion in 2024 earnings before interest and taxes. Outpaced estimates, although concerns over declining electric vehicles demand lingered. I think Ford and their electric trucks are probably going to go down the crapper just because, I drive a truck. I've driven, outside of an Explorer I drove in the 90s, I've had a truck since 1993. So was that 31 years now? And, I can't make sense of, the reduced power, especially if you live north of like Dallas. It gets pretty cold most, the second or half the year. So the batteries just don't make sense. All right. Uber Technologies marked a significant milestone, achieving its first ever annual operating profit, attributed partly to robust holiday demand for its ride sharing and food delivery services. However, Uber stock saw a muted movement in early U.S. trading. Chipotle Mexican Grill, Inc. also delivered impressive quarterly results with a 9% surge in its shares, driven by strong same-store sales growth and increased foot traffic. In contrast, Snap shares tumbled after the social media giant reported lower than expected quarterly revenue, falling short of projections. Similarly, New York Community Bancorp faced a 1% decline despite efforts to assuage concerns about its financial stability following downgrades from JP Morgan and Bank of America securities. Energy stocks lagged behind the broader market as oil prices retreated, reversing earlier gains triggered by a substantial increase in U.S. weekly crude stockpiles. Schlumberger, Halliburton, and Hess corporations were among the notable losers in the energy sector amidst the mixed signals in the oil markets. All right, so that's what's going on today in the markets. Let's dive into an article here from Zero Hedge. It's if you're wondering, why the economy is still remaining so tough. Here we go. How the U.S. economy remains so resilient in the face of much higher rates. Here's the answer. This was written by Deval Joshi of BCA Research. See what he had to say. All right. In a comprehensive analysis by Deval Joshi of BCA Research, the premature celebration of subdued inflation while maintaining economic growth is cautioned against. Joshi argues that while the journey towards sustained 2% inflation without harming the economy is feasible, it remains incomplete. The recent disinflation, largely attributed to supply-side improvements, is nearing its limits, making the final stretch to reach the inflation target challenging. And why 2%? Let me just stop here. I mean, is that just so the Fed and the government can rob us of inflation at 2% at a time? And, because if it goes up, much higher than that, everybody starts to get panicky and mad because their grocery bills, and gas and things like that go up. So, but why 2%? Why does everything have to get more expensive at a 2% rate? That means the cost of living doubles every 35 years. I mean, why aren't things getting cheaper? I mean, things like TVs and cell phones and all that stuff, drops in price, and probably in relationship to gold. I mean, they're probably dropping like a stone. But everything else. I mean, if you look at things like an ounce of gold to a price of a house, those things stay relatively stable over time. It's the dollar that loses value. All right, let's get back into this. Joshi underscores the importance of wage inflation, emphasizing that sustained 2% inflation necessitates a return to 3% wage inflation, a level yet to be achieved. Despite recent short-term fluctuations, longer-term trends indicate the need for sustained wage growth. Moreover, Joshi highlights the pivotal role of job vacancies in driving wage inflation, indicating that further declines in vacancies are required to achieve sustainable wage and price inflation. He points out that the recent improvement in the labor supply has been a primary factor in benign disinflation, but this trend is likely reached its conclusion. Examining global implications, Joshi draws parallels with the UK and Europe, emphasizing unique factors impacting wage inflation dynamics in each region. From an investment perspective, Joshi maintains a bullish structural stance on bonds, despite recommending a tactically neutral approach following a rapid bond rally. Similarly, a cautious outlook is advised for equities, which are stocks, with potential consolidation anticipated alongside bonds. Lastly, Joshi suggests potential upside in the U.S. dollar/euro, driven by differing monetary policies between the Federal Reserve and the European Central Bank. And that's something, looking at the dollar index, it is significantly improved over, and actually, I could probably bring that up on the screen here. Here we go. There's the dollar index. And so here's the chart for the dollar index. Let's go out 5 years. And you can see back before, the whole COVID nonsense, it was, just under 100, not, nothing too crazy. If we go out even further, so like it in the, let's see, after the dot-com bust, it collapsed, was, trending below 90, between 70 and 90 through the better part of the Obama years. And it strengthened quite a bit right before the 16 election, stayed pretty stable, and, dropped a little bit during the pandemic, and has done nothing but get stronger over that time. And my point of bringing this up is that, the dollar index is compared against, I think it's 6 other currencies. And our currency is stronger today than it was, before all this nonsense started. So what that leads me to believe is that the inflation and the currency manipulation is worse everywhere else. So, as things start to get, which leads me to believe that, the European markets, especially, are probably going to be in a tough spot as things start to recede as far as, the momentum of their economies. So, the dollar may strengthen even more before it finally collapses. All right, let me get out of there. Yep. All right. I think we're done with that article. Yes. All righty. Next up on the docket here, the International Monetary Fund, or IMF, sounds warning over U.S. commercial real estate market. Something to pay attention to. All right. The IMF has issued a stark warning about the precarious state of America's commercial real estate market, citing concerns over rising and maturing debt coupled with declining property values. Since the Federal Reserve's interest rate hikes began in 2022, property values in the U.S. have dropped by 11%, a more pronounced decline compared to past tightening cycles. This rapid devaluation is attributed to the Fed's aggressive monetary policy measures. Well, again, they printed, $5 or $6 trillion to save us? So the commercial sector, particularly office properties, faces multiple challenges beyond rising interest rates. The COVID-19 pandemic led to widespread business closures and a shift to remote work, resulting in record high vacancy rates averaging around 19%. With occupancy rates hovering around 80%, many buildings struggle to generate sufficient rental income to cover debts. The IMF highlights the staggering $1.3 trillion in commercial mortgage debt due this year in 2024, with a significant portion tied to office and rental or retail properties. Particular concern is the exposure of small regional banks and commercial mortgage-backed securities to this debt. While the IMF hasn't predicted an imminent crisis akin to the 2008 housing market crash, its cautionary statement underscores the potential risks looming over America's commercial real estate sector. Yeah, and I personally think that there's going to be, kind of a recalibration. I mean, we've already seen it over the last 3+ years with more people working remotely. I've been doing it for, well before that. But, I mean, personally, I think you get more work done when you don't have the distractions of getting up at the crack of dawn, driving to an office. Sometimes that office is an hour away, sitting in the office. I mean, there's a lot of wasted time between breaks and meetings and all that stuff. Whereas, here I can get all my stuff done and, knock out other things in the meantime, because there's always free time. So, I mean, unless I have back-to-back meetings all day, which, that's not all the time. So anyways. All righty. Last up on the docket here comes from Not the Bee. It's this article titled, Americans are now under 1.13 trillion in credit card debt. Guess which age group is having the toughest time of it? It's not me, not my age group. All right. The Federal Reserve Bank of New York's recent report on household debt reveals a staggering milestone. Americans collectively owe over 1.13 trillion in credit card debt, marking a record high. This debt surged by $50 billion in just the fourth quarter of 2023, with credit card delinquency rates rising notably, especially among younger millennials burdened with student loan debt. Despite a downward trend during the pandemic and Trump's administration, credit card borrowing skyrocketed as the economy reopened and Biden took office, growing by nearly $100 billion annually. With student loan payments resuming, many are struggling to meet credit card payments amidst heavier borrowing. Well, maybe if you'd gotten a degree in something that actually would, compensate you with a wage that to pay off your debts, that would be a better idea. But I'm sure that, gender studies degree is really paying off. The surge in debt comes alongside soaring prices for essentials like food, gas, and housing, leaving many consumers feeling financially strained. The average credit card interest rate now exceeds 20% at an all-time high, further exacerbating the problem. Matt Schultz, chief credit analyst at LendingTree, warns that the trajectory of credit card debt is only set to worsen, driven by persistent inflation and rising interest rates. Excuse me. As a result, individuals are urged to take proactive measures such as cutting unnecessary expenses, selling assets, and adopting frugal habits to tackle their debt burdens amidst uncertain economic conditions. And I think in the article it said, cut up your credit cards, buy rice and beans, and save your ducats so that you can, pay off your bills. So it is possible. My wife and I are, other than our mortgage, are debt free, and we got a small loan on our trailer we're paying off. But other than that, nothing. And it feels good. I mean, there was a time probably 15 years ago, it was like, God, we got bills and all this stuff. And, so it's, it does take a lot of, relief off your shoulders to not have all these, all that expensive, something bad were to happen. So anyways, all right. Well, that's everything I have for today. If anyone needs anything from me, please go to, we got a new thing here. Go to DSAFinancialGroup.com. All my contact information's there. I hope you have a wonderful evening, and I shall talk to you guys next time. Adios.